The December Fed meeting, and my next guest is here to share her outlook on what their next move might be, how it could impact the market moving forward. Let's bring in Anastasia Amoroso, Chief Investment Strategist at iCapital. Welcome back. It's good to see you.
Good to see you.
You bullish as we turn the calendar? I mean, we're obviously on a roll now. Can it last?
Well, I think it can last till December 13th, and I really circled
December 13th. That's it.
December.
All right, mark your calendars, everybody.
Well, the reason I say that's of course the next Fed meeting, and there's clearly a big disconnect going on in the markets right now because the last thing we know from the Fed is that they don't actually intend to cut rates all that much in 2024, and the market discounted 100 basis points of rate cuts at this point into 2024, and that's what propelled and catalyzed this rally. But what does the Fed actually say on December 13th? I want to hear why and if would they actually cut rates. And what I fear they might say is, look, inflation is still at 3.7%. Core measures, it's still not at 2.5% or 2% like we need it to be. If you look at the sticky services component, it's annualizing the last 3 months, annualizing 4.9%. So are they really going to declare a victory, or are they going to say, well, I think we've made progress and we're going to stay high for longer?
I know, but isn't it just enough if they, continue to lead us to believe that they're done hiking? Why do we need clarity on cuts at this particular point? Feels like a little too soon for that.
Well, and they're not going to provide that. And of course, because what would happen, would have even more easing of conditions, and they don't want to do that. And I think the market is priced in the fact that we're going to be high for longer and we can deal with that. But now the market went a bit further and said, well, now we're going to have rate cuts. And if that's the case, you buy unprofitable tech, you buy small caps, and you buy all this stuff that's lower quality that's been rallying right now.
Do you not believe in that?
I don't believe in it yet, because I think the Fed really needs to deliver the rate hikes for this to really start to play out.
Rate cuts for this to really start to play out. And, I see different scenarios why they would actually cut rates. One of them, I think, would be a bullish one where they would go into the second quarter of next year and say, well, core PCE metric as a 2.7%. We've done our job, and now we sort of can cut preemptively while the economy is still muddling through. That's uber bullish. Is that far-fetched?
Well, we just don't know, right? Because the other scenario is that they are forced to cut rates by the markets, by the dislocations, by the defaults, the delinquencies. And so that's why that's really, there's a bullish and a bearish risk. But the base case is that we have this muddle through economy that is a muddle through for markets.
We got to ramp up here as we're in this final stretch. We do have about 20 minutes or so to go. And I just want to note that the Dow's at the highs of the day, more or less. We're 275, 35,222. NASDAQ is the outperformer again. Rates, as I told you at the very beginning of the program, I think we're at 442 on the 10-year. We can take a look at that, too, because as that's trickled down a little bit, you've had the NASDAQ pick up as well. And then the Russell 2000, which has really been the standout of late, as we were just talking about with Anastasia, up 6% or thereabouts in a week, is continuing to ramp here as well. Are you a believer? Let's just put the Russell aside.
Sure.
The underperforming sectors relative to mega cap. Do we still need to see or feel as though the Fed is going to cut before we can feel confident putting money there?
Look, I think you start to nibble, and I would say there's 3 areas that are really catching my attention now, which I haven't really thought about in the last probably 3 to 6 months. And the first one is duration and buying bonds, investment grade, high yield. I think you start to look to those because if the Fed does cut in 2024, the average cutting cycle was about 360 basis points. And even if they cut by 100 basis points, as the forecast or this consensus expects, that potential 8% upside if you're buying a 10-year Treasury, and then you in price terms only, and then you add a yield on top of that. So if you're buying especially a yield with a spread like high yield and investment grade, that's an equity-like return in fixed income. So that's one space that I really like. The other one that I think is rallying today, along with everything else, is real estate. And real estate has been beaten up, and the prices have corrected. And I had many conversations recently with real estate managers, and they're starting to see opportunity. Those were not the conversations 6 months ago, but they're starting to say, look, we've corrected 11% from the peak. Office corrected 30%. It might be a really interesting time to step in if cap rates on some of those properties are 7 to 8%. Yeah,
and maybe avoid the apocalyptic scenarios that some have predicted. It's good to see you. Thanks for being here.
Great to see you.
Have a great Thanksgiving. Anastasia Amoroso, iCapital.